Welcome to Excess Returns, where we focus on what works over the long term in the markets. Join us as we talk about the strategies and tactics that can help you become a better long-term investor.
Justin Carbonell and Jack Forehand are principals at Validea Capital Management. The opinions expressed in this podcast do not necessarily reflect the opinions of Validea Capital. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validea Capital.
Hey guys, this is Justin. In this episode of Excess Returns, Jack and I talk with Greg Reid, president of real assets at Westwood Group Holdings and lead portfolio manager for the $2 billion energy investment team. We start with Greg on the energy market and the assets and the types of investments that investors have to choose from MLPs, LNG, gathering and processing, storage, and renewable energy producers. We then move to MLPs and why these are the types of investments he tends to favor. We conclude with a new investment strategy Westwood has deployed in an ETF wrapper to harvest an even higher yield than the typical MLP throws off. Lots of interesting info in this one. As always, thank you for listening. Please enjoy this discussion with Greg Reid of Westwood Group Holdings. Greg, thank you very much for joining us today.
You're welcome. Good to meet you guys.
We were talking before the show, and someone's dedicated when they've been flooded out of their house and they don't have energy, and they're still, we're still fortunate enough to have guests that want to come on Excess Returns and talk to us and our audience. So we really appreciate it, man.
You're welcome.
What we wanted to do today is have you on to talk about what you've been investing in, I think, most of your career. And we're going to talk energy, real assets, MLPs, and also I think some of the new strategies that you guys are developing to get even more yield out of some of these already higher yielding type vehicles. So it'll be, I think, a good discussion. We'll sort of start high level and then work our way down into specific investment strategy stuff, which our audience always loves. Energy, to me at least, and you can I'll let you sort of riff on this, but it seems to me like energy now people might be paying more attention to energy now more than ever, just given sort of what's happened in the world, given what's going on with AI and the future demand for energy. Or maybe I'm just, that's recency bias working in and I'm like convincing myself of that or something. But to start, we thought it would be good to just have you give sort of a high level overview of the energy landscape and what sort of you're seeing as the current big trends today.
Yeah, no, I think that's a great way to start. And I think you're right. People are more focused on energy right now because of the Russian attack in Ukraine. And then more recently here, the issues in Israel. Energy is an important part of everyone's conversation. Yet it's a pretty small part of the S&P 500. It's, 4%. But what we've all learned, I think, for the last 3 or 4 years is that we can't really run the world today without a meaningful amount of traditional oil and natural gas, and unfortunately some coal to boot. Traditional energy is the most important fuel for the economy. And as much as we all like to use more solar and wind, we've learned they're not reliable and they can't be produced in large quantity at affordable prices. So we're going to be stuck with traditional energy for decades to come. And that's even before we started building these great big new data centers to drive AI that require a lot more energy. And so what we've seen over the long run is energy demand for crude oil at least has been kind of in the 1% to 2% range for decades. And the only thing that knocks it off that type 1% to 2% growth range is a big depression like '08 or COVID. Besides that, it's kind of slow and steady. And yes, it may flatten out at some point in the future, but it looks like, many parts of the world, India and China in particular, want to have our Western standard of living, which requires a whole lot more energy to operate our economies and frankly, all these devices that we all have, computers and iPads and phones and transport, all that stuff requires energy. So that's kind of the direction we're going. And the U.S. is the largest producer of oil in the world. We're doing about 13.2 million barrels. Russia's around 10 and Saudi's around 9. So many Americans really don't realize we're actually the largest producer of oil and gas in the world. OPEC is bigger in the aggregate, but we're larger than Saudi Arabia. And so we're a very important player in the traditional energy markets.
Yeah, that's kind of amazing. Like, when did that amount of production sort of come online for the U.S. and just in terms of timing, to put it in perspective?
Well, we declined for 40 straight years until around 2000 when we invented the the shale revolution basically and horizontal drilling and fracking basically turned the U.S. into a growth play. And so we were in a long-term secular decline with conventional production. And really, our new technologies allowed us to basically change that. And we grew from about 5 million barrels a day up to about 13 million barrels a day of production. We unlocked a bunch of traditional oil and gas trapped in these rocks underground. And that really changed the global energy world. You can only imagine, if we were still shrinking and Russia and OPEC were the dominant oil producers in the world, they would have a lot more power over the United States and Europe. Thankfully, they don't, because we're a larger producer and we can fight back with our energy power along with our military power. So the fact the U.S. is the largest producer is really important geopolitically for us. We have control over our own energy. And a lot of places in the world, like in Europe, they don't. They're importers and they have to rely on Russia or U.S. LNG imports to basically fuel their power plants and their manufacturing facilities.
Is the U.S. a net exporter of energy at this point?
Net exporter, yeah, we are a net exporter because we export a lot of LNG and a lot of NGLs, natural gas liquids. So we are exporting more than we import, certainly. If you add up, crude oil plus NGLs, we're actually producing about 20 million barrels a day, which is substantial. That's double Russia and Saudi Arabia when you add up natural gas liquids into the mix.
On your website, you list 5 significant areas within the energy industry. And so we thought we could kind of maybe work through these in some detail to just get our arms around what exactly they are and what types of businesses they are. So the first is pipelines.
Yeah, so pipelines, think of it like crude oil pipelines, the best example. The Permian in Texas produces around 5 million barrels of oil. You have to take it out of the ground and pipeline that back to, say, Houston, where you move it into refineries and produce gasoline. So the transportation of oil through a pipeline to a city or refining complex is really one of our main businesses. And there are crude pipelines, natural gas pipelines, and NGL pipelines. So you have a variety of different kinds of pipelines, but that's the basic building block of our industry, is pipelining some product to a larger market center.
What types of businesses exist like inside pipelines? Is it like a few major players, or how does that work?
Well, you have a number of companies like Plains All American and MLP, based in Houston, is the largest crude oil pipeline. Then you have natural gas pipelines. The 2 best examples are Williams and Kinder Morgan. They have a lot of natural gas pipelines. And gas, you can imagine natural gas being a gas. When you put it into pipeline, that's the way to transport it. And the natural gas that is brought to largely a coastal market, if you freeze that down, you can create liquefied natural gas, which is LNG, and you can export that on a ship. So that's actually a very large growth engine. Cheniere is the best company that's an example of that. That's the largest LNG export company in the world. They're based here in Houston, and they're growing rapidly because a lot of countries like in Europe, for example, and Asia, want to replace traditional coal type power with natural gas. And it's a cleaner burning fuel and more environmentally friendly than traditional coal would be, for example.
So yeah, you hit LNG. I'll have to ask you offline, Greg. I have get your feedback on a small speculative LNG stock that I own. I'm still waiting for.
Okay.
I'm waiting for my 1,000 bagger. I don't think it's going to come. Anyways, what about gathering and processing?
Yeah, so gathering and processing is a company such as Targa is a good example. They're in the Permian Basin. Large customers are Exxon and other public E&P companies. So every well that's drilled, oil well, produces oil, natural gas, and natural gas liquids. It's not all one thing. It's a mix of assets. So someone has to basically create a pipe to each well to bring the commodities to a centralized processing plant. So natural gas gathering is, gathering and processing is gathering from every well these smaller lines to a major processing plant to basically treat that where it can be sent in larger quantities through a larger diameter pipeline. So think of it like a thin straw gathers from every well, and then when you get it, you bulk it up at a plant, you put it in a 36-inch, 3-foot wide pipeline to bring to Houston or Corpus Christi or somewhere else like that.
In addition to, just going back to LNG for a second, in addition to Cheniere, what other, just a few other major players there?
Well, unfortunately, the only big one is Cheniere. There are
Okay.
a couple small ones, and the ones that are in our index are Tellurian, 56 cents, and Next Decade is in the process of trying to build some LNG exports. So there are two small companies that don't really have any export capability, and they're speculative stocks because they don't really have the contracts and the plants built. They're almost like options. You're buying the potential that they're going to have a plant in the future. But Cheniere is a dominant player. They're investment grade. They're the largest in the world, and they're adding new plants. And so now there should be 3 or 4 more Chenieres. There are private LNG companies in the United States, but they've chosen to stay private because, frankly, a lot of investors just frankly aren't wanting to be public these days. In energy, you're not getting a lot of love from investors. And if you can finance your business and stay private and keep control, that's a pretty viable strategy to not deal with the public investor base that, every quarterly conference call asks you questions about ESG and what are you doing here and there. And so if you can finance it privately, that works pretty well too.
And can you just comment on just, is there like some permitting issues around, what the Biden administration sort of might allow permits for, which also makes it maybe difficult for some of these companies?
It's definitely difficult to get a permit for new pipeline construction. We've seen the Northeast Mountain Valley Pipeline has struggled for years to kind of get their pipeline built, and the environmentalists have been successful blocking it until just recently. They actually they're finishing it up right now, but they had, I think, 4 to 5 years of delays and cost overruns that doubled the cost of it. So it's very difficult to get new permits to build any kind of new pipeline, unfortunately. Just recently, the Biden administration paused LNG, new project approval in LNG. That was a very political move. It was a convenient 9-month pause to study the impact of LNG, basically, from like January of this year until the election. Once the election's over, they're probably going to come out and say LNG is better for the environment. There have actually been 5 studies that have already been completed. And every time they come back and said, this actually reduces carbon relative to other things that are being used, like coal and crude oil, and therefore LNG is a cleaner burning fuel, and the government said thumbs up in the past. So that was really just a convenient way to basically try to gather some more votes from folks that are more climate focused, and the pause will, no matter who wins the election, that pause will probably go away in the first quarter of next year.
Yeah, when you were talking about the pipelines and the different pipes that go into different places, I was thinking we all take that for granted until it doesn't work. Like there's been a few major incidents, I don't know, in the past decade or so where a certain region is like dramatically affected by one of those things, and when it's not working, you've got major issues on your hands.
Yeah, it's kind of like Houston today. Okay, so I told these guys before, I'm in Houston. We had a storm hit Thursday night. Our power went out. And so, utilities and power is something you take for granted until you don't have it. And so my house has no power. It's 95 degrees in Houston. You can't air condition your house. So you got to find somewhere else to live. So I'm sitting here working in my nephew's house, hoping he doesn't come back home. He's in Europe right now. So that's an example where it works until you're sitting there in Europe and Russia cuts off your gas or charges you a lot more money, and you basically have a massive problem on your hands.
Yeah, we're thankful you have AC here. We would not have asked you to do your podcast in 95 degrees. I guess that technically would have been putting you in the hot seat, but we would not have done that.
Exactly. Thank you.
The next area you had on your website is the area of storage. Can you talk about what that is and what major players are there?
Yeah, so storage, a great example of that is Enterprise Products and MLP in Houston. They have underground storage in a place about an hour east of downtown Houston called Mount Bellevue. And it's actually the largest underground salt cavern storage in the country. So what they do is they pipeline NGLs, natural gas liquids, and other liquids to Mount Bellevue, and they stick them underground in storage. And it's a natural storage container. Effectively, salt, forms a very natural, safe way to store chemicals or the product. And so what they do, they store it down there until they want to ship it and export that, typically abroad. And so that's a natural storage tank. And you might have, you could just store for 6 or 12 months. For the most part, you're just putting it there temporarily until you export it or use it in the refineries. And so it's just it's a nice way of storing extra product. The government itself stores crude oil underground. The Strategic Petroleum Reserve is another way of saying storage. They store oil for a rainy day when we need it. If oil spikes, they've released oil from the SPR to try to basically cushion the impact of higher commodity prices.
Is that the SPR? Is that something that's like spread across the country or something? How does it work? Like, where do they store it?
Different locations throughout the country. Exactly right. Typically, you're going to store the SPR close to refineries because crude oil in its raw form is mainly just used to make gasoline and diesel and things like that. And so you want to store it close by the refineries. So if you can't import oil, so for some reason, say oil goes to 200 because of a war somewhere, you want to use your own storage and oil to kind of run your refineries and try to bring down the cost of gasoline. So during the Russian war, President Biden drained the SPR by about 30%, I believe, to try to cushion the impact of higher commodity prices, and that was partly responsible for driving inflation higher. Was high gasoline prices, and so you can let them things out of storage to reduce the price impact for consumers.
How about renewables? You mentioned those a little bit earlier, and it didn't sound like you were too optimistic in terms of their ability to replace traditional forms of energy. But how do you think about renewables?
So renewables they're one of the many sources of energy, and very important that we are using more of them. There's actually a pretty good growth rate in the renewable space, and we're seeing massive subsidies from President Biden's IRA that went through 4 years ago roughly. There's a lot of government money afforded to renewables. The problem is that the returns first of all, they're not reliable because the wind doesn't always blow and the sun only shines half the time, and then when it rains, it doesn't shine. So those two kinds of renewables aren't very reliable. But everybody wants power 24/7. So they're an important part of the energy mix, but they're not a very big percentile of that mix. And what we found the last 3 years is that to make the math work for a lot of these renewable developers, you need lots of leverage. Well, we're in a higher interest rate environment. So you can't leverage these renewable projects enough to make the returns you need to subsidize them. And so the truth is, renewables are going to probably grow at a pretty high rate, but from a small base. And they're going to be more expensive forms of energy. So that naturally is inflationary. The more we force renewables to grow and be a higher part of our energy consumption, the more inflation we're going to have. And the Fed's number one goal is to bring down inflation. So they actually pushing more energy into renewables is actually inflationary and defeats the Fed's number one goal of bringing down inflation. So how about that? We can't use more without creating more inflation.
So you're not too optimistic then about the ability of renewables to take like significant market share from the traditional energy sources soon?
Not going to happen.
Okay.
Almost impossible. Yeah, and I think we see that now. We're basically 2 years post the attack. I mean, we were all a lot more optimistic about renewables. I'm not saying EVs can't replace a lot of combustion engine cars, because that is it's happening to some degree, but we're even seeing there that Hertz dumped a lot of their EV fleet. And now it's difficult to even sell EVs on the new dealer lot. So people just didn't like waiting in line. The infrastructure wasn't really built to get the charges like you wanted. and the radius was only 250 miles, and it's not very convenient for a lot of people. So the bloom's kind of off the rose to some degree on renewables. The returns have not been good. Yeah, returns have been pretty poor the last 3 years on clean energy in general, and so it's just been a more challenging area for a lot of people.
So just on going back to the renewables and inflation, I think that's sort of very interesting and concerning, because I think there are, some regulations in states that are like requiring like utilities, for instance, to source, certain percentage of their energy from these alternative sources. And if you're saying that that's a more expensive form of energy, then you could see how that, like in terms of someone's power bill, just a very simple example, how that flows all the way down into, more expensive energy and therefore higher inflation.
Yeah, that's right. And I think at the end of the day, renewables are going to grow a lot, and then that's a good thing. It's better for the planet to lower carbon, but it's going to be a more expensive form of energy that's less reliable. And so we're going to have, as consumers, we're going to have to get used to paying more, and we have to know inherently that moving from lower cost power sources to higher cost power means more inflation. So it's going to be an expensive proposition for this planet to move to a lot more renewable sources of energy. It's more expensive whenever for the most part, companies want to lower their expense structure wherever they can, right? They move manufacturing to China to lower manufacturing costs. Well, now the world's trying to figure out how to move a lot more traditional fossil fuel consumption, which is lower cost reliable, to higher cost less reliable. How does that sound? Not very good.
Not good.
It makes you feel good that we're using renewable sources, but then you're upset when you pay twice as much, per unit of power, and it's not as reliable, and your power goes down. So it's something we're going to have to deal with as a world. Now, the truth is, the big opportunity in the world is getting China and India to stop building coal plants and use LNG. That's the best thing we could do for the planet, is not build more coal plants, but rather get them to move into cleaner burning natural gas and, yes, some solar and wind. The problem is they don't want to use higher cost forms of power. They want to use low cost coal because they have a lot of it. And so that's what's polluting the planet, is all the coal fired power plants. And guess what China's doing with it? They're fueling their EV cars with coal-fired power plants. So you're not really helping a lot by converting to EV if you're charging them with coal plants. And that's inherently the problem. It sounds great you're selling more of EVs in China, but you're fueling it with a lot of coal. And that's making the planet a dirtier planet, unfortunately.
Do you know roughly like what the market share of coal is around the world? Like how much coal, I have no idea about this. Like how much coal is still used?
Coal's larger than you think. I don't know the exact numbers off the top of my head, but many people would guess coal peaked 10 or 20 years ago. It hasn't even peaked yet. It's still growing because, when you have countries like China and India with over 1 billion people that are building new coal plants, the global consumption of coal has been increasing, I think, for 50 years now. Now, the growth rate is slower, no question about it. But what we want to do is actually make coal peak and decline. That cleans up the planet faster. So the U.S., for all the good we want to do, the best we could do, and this is another argument I can make, is that the best thing we can do, because the U.S. is so ESG focuses tighter standards, like we talked about earlier on pipeline construction, we are actually the cleanest producer of fossil fuels like crude oil and natural gas, far cleaner than OPEC and Russia. So the best thing we can do if we're super focused on ESG is produce a little more natural gas in the U.S. and don't let Russia produce it, because we're going to produce cleaner natural gas, and we can hopefully sell that cheaper to China and India and other countries that are building coal plants. So that's really the best thing net for the world, is to produce more cleanly here and help transition away from coal as fast as possible. But that's another story altogether.
As we talk to people who are experts in a wide variety of industries in the podcast, we've been hearing a lot about how technology is really going to change the world, say in the next 10 years. And I'm just wondering, like in the energy space, are there things you're seeing like that in terms of things you're really optimistic about how things will change significantly for the better?
I think AI is certainly a very popular topic, and AI is really exciting. We one of the growth opportunities for traditional energy is that these data centers are becoming larger and require a lot more power. To fuel an NVIDIA chip takes a lot more power than a traditional, chip, a computer chip. And so the continued acceleration of AI and the size of the data centers looks like it's going to provide some additional growth opportunity for the traditional energy market and for utilities. And so what we're seeing is some of these new data centers that are a significant scale be placed in Texas and Pennsylvania and Ohio, close by natural gas power plants or natural gas sources that can fuel power plants, I should say. And so that's not going to drive the entire industry, but it's additional growth for the sector that people just 3 years ago were questioning, is there any terminal value for a natural gas pipeline? Well, it looks like there is more demand needed over the next several decades for natural gas power, and that kind of takes away the argument these power plants or these natural gas pipelines don't have any real terminal value beyond, let's say, 10 years. And so just having the longevity of that need for power helps make people believe that, yes, there actually is a long-term need for traditional sources of energy, whether it's oil or natural gas or, whatnot.
If we think about like the cost to deliver this stuff, the cost to extract things from the ground, is technology making a big improvement there? I mean, I could think on one side, that stuff is very highly, manual. It doesn't seem like technology would make a huge difference there, but are there potential for big strides in terms of across the, the chain here, the cost of energy and how we get it to people?
Well, the big changes I'd say are largely occurred, moving from vertical wells that were straight down to horizontal wells that went down then fed out horizontally. That was a huge technological change. And then fracking the reserves underground or the rocks underground unlocked a lot more oil and gas than we thought existed. And so I think that has already happened. Now it's largely only being used in the United States. So to the extent that, they did this over in the Middle East or in Russia or other parts of the world that are more using conventional technology, you can unlock some more oil and gas there. So I'd say the big technological revolution already happened. And so now we're probably more in a steady state type of situation. We don't need to grow a lot in the United States now. Just fairly modest growth of 3 or 4% a year is all you really need production growth to meet the world's needs, is the way I look at it. So we're not looking for any major new revolutionary technology. Now, where we really probably need it is on the renewable side, battery power for storing energy, and then also for nuclear. And so if we could somehow crack the code and make small scale nuclear plants more efficient and affordable, then you could see a lot more of those be built in the United States. So, and that's directionally, I think, I'd like to see a lot more nuclear be built around the world than we have today. Unfortunately, most of the world's still so scared about Chernobyl and what happened in Japan to allow nuclear to be built. Many countries aren't building nuclear, and our experience here on large-scale plants has been, pretty abysmal. So many people have kind of said, no more, we just can't afford it. It's too costly and too dangerous to pursue the nuclear option. So that's a long-term solution that if we can somehow improve technology there and prove it out, that there could be some opportunity for growth there.
For the second half, I want to shift and talk about MLPs because you guys just launched a very interesting fund in the space. And to be honest, I didn't know a lot about MLPs. I did a lot of research before I talked to you to make sure I at least had some idea what I was talking about. But just to start, for people like me, can you just explain what an MLP is, like the important characteristics of them?
Sure. Yeah. So MLP stands for Master Limited Partnership. And so what it is, and these were developed back in the 1990s, is they're publicly traded partnerships that don't pay any corporate tax. And you have to have what's called MLP qualifying income, meaning from natural resources such as oil and gas to qualify. So you can imagine if you're a corporation making money, if you can be in a partnership structure and not pay any corporate tax, that saves you a lot of money. And that's how MLPs were created, is to be effectively flow-through vehicles for investors. Now, 10 or 15 years ago, MLPs was 75% of the industry of energy infrastructure. Now they're only about 25%. So MLP is just a tax structure, is all it is. So it's only a quarter of the space. The three-quarter part of the industry are C Corp companies. So the broad space, we call it, is energy infrastructure. That's comprised of MLPs at 25 to 28% and C Corp companies that are traditional corporations that issue 1099. So the industry itself is really called midstream energy infrastructure, and MLPs are a relatively small part of it today. Many MLPs have been rolled up by their C Corp parent company, and the space has kind of become more of a C Corp type space.
Why is that? Why are MLPs so much less than they were?
Many investors don't want to get a K1 is the biggest reason. It's a hassle. You know, if you own 10 MLPs, you get 10 K1s, and it's a pain for filing your tax return. They also produce UBTI, unrelated business taxable income. And so most mutual funds don't own MLPs. They don't want to deal with having to file K1s. Most people prefer a 1099. So that's the biggest reason. And I think that's why the space has become more C Corp in nature. And the truth is, you don't need to have a bunch of MLPs out there. You can get the yield benefit through a C Corp structure. And the companies themselves don't pay a lot of corporate tax because they have a lot of depreciation. And so we find today a lot of public midstream companies like Williams and Kinder Morgan, they don't have a very high corporate tax rate anyway. And so they issue a 1099 and don't have a very high corporate tax rate. That's a pretty good solution for most investors.
Can you explain, you use the term midstream, and you see that all the time with these MLPs. Can you explain what midstream means?
Yeah, the best way to think about it is the energy industry is around 4% of the S&P 500. That is comprised of about, 2.5%, 3% upstream producers like Exxon and Chevron and Diamondback that are producing oil and gas by drilling wells. That's the majority of the energy industry. Then you have midstream that are natural gas and crude oil pipelines that we talked about earlier. They're like the middlemen, and then the downstream part of the market are refineries. So upstream produces oil and gas by drilling wells, midstream transports it, and refineries basically create gasoline for your car. And those three segments are the energy industry. Kind of down, midstream, and upstream are the three component parts. So it's basically kind of three ways to get the product to market is the way you think about it. You got to find it, you got to transport it, and you got to refine it to create the usable ingredients for people, like gasoline or diesel for your car or truck.
And what do you think is attractive about investing in the midstream area?
The midstream is attractive because as the middleman, it's a pipeline infrastructure business. We're not looking for oil. We're not refining oil. We're just trying to basically move it from point A to point B. And so for the most part, you're getting paid fees to move it from like the Permian in Midland, Texas to Houston, which is, hundreds of miles away. We charge a fee of like $1 a barrel or $1.50 a barrel to move the oil to a market. So it's like a transport cost, like trucking. And you're getting paid a fee to move that volume, and you don't take the commodity risk. You just kind of get paid a fee for movement. That's what I like about it. We have a higher dividend yield in our space of about 6%, whereas the upstream space only has a 3% dividend yield. So our space has a higher dividend yield and more stability to it. The correlation is only about 40 to 50% correlation to oil. And so it's more like a infrastructure business. And many people want the yield without the commodity risk. That's what we offer, is the income with less commodity risk.
And is it fair to say that MLPs pretty much operate exclusively in the midstream space?
No, they don't. There are some squirrely little MLPs out there that are involved in other segments. like fuel distribution, SUN's an MLP. Actually, Alliance Bernstein, a money manager, actually is a MLP, or what they call a PTP, publicly traded partnership. So there are a few other categories that are not midstream that are MLPs as well.
And how many MLPs are there?
I think if you look at the index, Larry and MLP index was around 14 MLPs, whereas in the midstream area overall, there are like 25 stocks in the broad midstream index today.
And MLPs will, I mean, it seems like MLPs always generate above average yields. Is there a reason for that?
I think because they were built to attract retail investors, they were always more of a yield product. So you're right, MLPs have about a 7.5% dividend yield as in the index. Midstream overall has about a 6% yield, so a little bit lower yield in midstream. And that's because of the corporate tax rate. It takes away some of the cash. And then there are a couple of companies like Targa and Cheniere that have low dividend yields of 1 to 3%. As a C Corp, you don't tend to want to pay out all your cash in dividends. You tend to keep more for reinvestment in-house, whereas MLPs have always been kind of built to pay out most of the cash flow to investors. And so you find MLPs have a higher yield to attract retail investors.
When you're looking at companies in this space, what are the key metrics that you pay attention to?
The most common one today is just look at enterprise value to EBITDA, EV to EBITDA. We look at all public companies using that scorecard. What you find is MLPs are around 8 times EBITDA today. C Corp midstream companies are around 9, and the S&P 500 is around 13 to 14. So we are value equities trading at lower multiples, and energy as a whole is less popular, frankly, with investors, and so they kind of tend to trade as value stocks with higher dividend yields.
So you mentioned before that MLPs are about 25% of the universe. Like when you look at your fund, is it similar to that? Do you have something similar to 25%, 75?
We do. In our fund, we have to be below 25%. If we go to 30 or 40%, the fund gets taxed at the corporate rate,
Okay.
which is terrible. So we have to stay below 25% every quarter. Now, the truth is the overall industry is like 27%. So it's not that hard to stay at 25. It's very strategic. Now, if you go to an MLP only fund, you're going to see that it has 15 MLPs in it and almost no C Corps, but they're going to be paying tax at the fund level at 25% because you're paying corporate taxes at the national level plus state and local taxes in Connecticut, New York, California, etc. And so the effective tax rate of C Corp on the C Corp fund is 25%. So naturally, we want to minimize the tax drag on our fund. We don't want to pay corporate tax, so we cap our MLP ownership at 25%.
So when you think about taking the universe you mentioned and filtering it down to your actual portfolio, can you talk a little bit about that process?
Yeah, so we start at the highest level and kind of look at the full universe. We've been doing this now for about 20 years. We have a 6-person investment team. We do bottom-up fundamental analysis on each and every company, and it really is a bottom-up stock selection process. What we find is there's some companies that frankly have a different agenda, particularly in Canada. A couple of the larger companies have very high debt, north of 5 times debt to EBITDA. They're not generating free cash flow after CapEx and after dividends, and so we find those companies less attractive. And so they're very big parts of the index. They're like 9 and 10% each of the index, TransCanada and TC Energy and Enbridge. And so those are examples of companies that are running kind of a playbook that used to work 5 or 10 years ago. Whereas in the U.S., we find companies want to run less leverage. Enterprise Products is only 3 times debt to EBITDA and is generating lots of free cash flow and buying back shares. So we find that doing bottom-up fundamental analysis is really the most reliable way to pick the best stocks, and that we think generates superior returns. We can't just go buy the index because some companies, are running a different playbook. They're trying to basically avoid cutting the dividend to fix their balance sheet and keep leverage high, and we think that's a not a very successful strategy. The best thing to do is, perhaps to adjust your dividend lower, pay down debt to 3 to 4 times EBITDA, and cover your dividend higher with a lower dividend yield. So anyway, fundamental bottom-up stock selection effectively is the best way to run money in this business.
And so do you think the most important thing for you is filtering out the bad names, like you said before, versus maybe overweighting the ones you like the most?
I think, understanding the key drivers of the business, and going back to your question earlier about what kinds of assets do they own? Do they own crude oil pipelines, which have less growth? Or do they own natural gas and gathering and processing pipelines that potentially have more growth? What are they doing on the LNG export side? That's a growth engine. If you don't have that, you might trade at a lower valuation. So kind of understanding the assets you own is probably the most important thing. And then looking at the capital, the balance sheet, and the dividend coverage, and doing that kind of work. So definitely screening out some of the dogs and cats is important. I mentioned earlier, Justin asked, there are a couple of small companies in our space that frankly don't have any revenues, and they're public, but you could argue they shouldn't be public because they don't have any revenues or meaningful revenues yet. They got to build assets, and so we kind of prefer not to have stocks that are more speculative in our portfolio like that. Screening out companies like that and just focusing on the core, large cap, safer investment grade, or small to mid cap names that have a core business that's very solidly profitable.
And for the names that you do own, how do you think about position sizing?
Within our mutual fund, we typically keep things below 10%, and we're somewhere in that kind of 1 to 10% range. High conviction names, we could be 2x the index weighting. We don't feel any need to own every stock in the index. Obviously, we want to pick the best stocks and actively manage the portfolio. But we're in a relatively small universe today. Companies have consolidated down. Many MLPs have been rolled up. So it does kind of come down to more, how do you weight the companies more so than which ones do you avoid? And getting that weighting right is where you add your alpha. And also, there's a fair amount of volatility in our space. Being able to buy when things are weak and sell when they're expensive is a good thing, a good way to add value.
Do you see, you already mentioned how you look at valuation, but do you see like a wide range in valuation among the names in the index? I mean, is it pretty tight since they're similar type companies?
We actually do. The two Canadian companies that I mentioned to you were underweight, TRP and Enbridge. They traded closer to 12 times EV to EBITDA, whereas we have Energy Transfer down at 8 times EV to EBITDA. So 8 to 12, pretty significant number there. So in other words, they're 50% higher valuation, and they have 25% higher debt and like 25% lower dividend coverage. It's like a no-brainer. We want more of ET and less of those two companies, and they actually all are about 9 or 10% in the index.
Earlier this year, Westwood launched a new, I guess, what would be considered an enhanced income strategy within an ETF wrapper. Can you explain the underlying strategy there and what it produces in terms of yield and why an investor might sort of be attracted to it?
Sure, exactly. So we kind of walked through in detail our stock selection process for building a portfolio. We basically took that one step further. We said, okay, let's build a quality midstream portfolio. We use a RIC structure, so we cap the MLP exposure at 25%. So where we end up there is about a 6.25% yield on our portfolio. And we said, naturally energy is volatile because oil prices and natural gas prices move around. Let's do one more thing to add value. Let's sell a covered call on each and every stock. And let's try to monetize volatility and give investors more income. So we created an income solution. So it turns out you can basically own that same portfolio and write a 1 to 2 month covered call and make about 5% more income or yield. So our ETF, ticker MDST, has a 10.8% dividend yield. And it's really just a combination of the underlying portfolio yield of 6.25% and covered call writing that generates 5 to 6% annual yield, and that happens in the form of capital gains. And so what we do is use the ETF wrapper to try to tax efficiently manage the portfolio, try to minimize the amount of gains that we'll recognize over time, meaning we can use the share creation redemption process to try to mitigate capital gains and offset some of that covered call income. And so we're able to pay a yield that's double digit with the same underlying portfolio. And that's really what we're trying to provide as an income solution. Most people we talk to are buying midstream because of the yield.
Mm-hmm.
They're buying it because of that 5 or 6 yield. So if we can give them 10 to 11 and take away some of the volatility by selling covered calls out of the money, I should have told you that these calls are on average about 4 to 5% out of the money. So we're only capping our upside on a 1 month or 2 month basis, 5 or 6% out of the money. So we won't capture 100% of the upside, but we'll capture 85 or 90. That's good enough for most people if we can double the yield up to 10.5 or 11%.
Yeah, I think that's attractive to a lot of investors that are looking for, like you said, even above the MLP, something like 10, 11%. That's a nice yielding portfolio. What do you think are, I guess environments where there's less volatility, this would tend to be maybe better than if there was a really volatile environment where those cover call options might sort of detract from returns. But just talk about when it would work and when it wouldn't possibly work as well.
Yeah. So naturally, we're getting paid to sell option volatility. So we actually want the market to be, somewhat volatile. That results in more income on the premium. So a little more volatility is good up to a level, but we are capping our upside. So we want to, and we're not obligated to sell on every stock or every month. And so after a big correction, for example, if there's a 5 or 10% correction, we're less inclined to want to cap our upside up 5% because we expect it to rebound or might expect it to rebound. So thankfully, the last 3 or 4 years, last 3 years especially, our markets have been pretty stable with an upward bias. And so it tends to perform well in kind of a flat to up market. In a down market, selling covered calls will outperform a long only strategy because the call premium gives you some downside protection. So the ideal scenario is kind of in a down 10 to up 20, market environment for our industry. Covered call writing should outperform with less risk. If the index is going to do better than like 20, we'll leave some money on the table. And if it falls 15 or 20%, the money we make on covered call writing will be small relative to the loss. And so you probably shouldn't be in the space anyway. But it's hard to predict those big drawdowns. So at the end of the day, this should work most of the time. We're effectively just harvesting volatility in the market and getting paid to take equity risk is how we think about it.
So you have the flexibility to decide if you want to write the calls or which stocks you want to write them on.
That's right. And some stocks just don't line up. For example, there are stocks trading at $37 that we own that you can only write calls at 40 or 35. And the 30, we're never going to sell it in the money call. First of all, we're only going to sell out of the money calls. So we're never going to sell it in the money call. So the $40 call may only have a 5-cent bid. We're not going to sell that call. It's not enough premium. So in that stock, we'll probably just sit here and hold it and get a 5 or 6% dividend yield and do nothing. But if we own a stock at, let's call it, $16, and we can sell a call at 17 and make 30 cents every month, that's a pretty good addition to the return. So we'll do that. And so there are just naturally the truth is every day we're creating a new model portfolio. And some call strikes just don't line up, and other stocks we think are too cheap to write calls on. So we expect to have covered calls on, 90% of the portfolio, but we're not obligated to. We can make our numbers work. If there was a large drawdown, 5 or 10%, what we've typically seen is those kind of corrections, you get a bounce back. And so we would be hesitant to sell calls for the next month. We'd want to just let things rebound before we write more calls. So we have the flexibility to actively manage it and not cap ourselves too much after a big correction.
By the way, this is one of the beauties of the ETF, right? Like 5 years ago, a strategy like this might have been launched within a mutual fund. But, now it's like managers like your, Westwood and others. I feel like it's more and more coming around to, if we're going to launch a strategy like the ETF wrappers, like Superior. And by the way, I was looking, the fund has, you launched it in early April of this year. So we're a little bit over a month from the launch, and the fund has 32 million in assets. So out of the gate, it's been well received by investors. And I'm sure you had a lot of the people that follow you in Westwood probably were interested in this type of vehicle. But 32 million in the first month effectively is a good initial launch.
Yeah, we're off to a good start. And we for years, like over 10 years, the question that we've never been able to answer is, people have said, can you give me your midstream strategy with less volatility? I just want to get the yield. Well, guess what? Selling covered calls lowers the volatility, because you basically take a long only product and you cap the upside up 5%, and you get paid for that over and over and over again. So we've run the strategy actually in separate accounts for about 1.25 years now. What we found is the beta to the index drops to about 0.85, and we double our yield. And so I think for a lot of people, looking at IRA accounts, for example, this is a perfect strategy for an IRA. You get 11% dividend yield, and you don't pay tax in your IRA. So the covered call income, if it does come through, some is short-term cap gain. You don't care in an IRA. And so for many people, they're looking to get most of the upside with less downside risk. It kind of fits the bill. You're getting paid to take market risk. Now, in a lot of other equities, the S&P 500, for example, you don't get much dividend yield at all. You're paying to take risk. You hope it goes up, and your return is really from it going up. Well, that generally works, but there are times it doesn't work. So here, you're getting paid to just have exposure. And really, kind of what you want to happen is flat to up a little bit, and you make 11. That's good. So it's just it's a better way to get paid to take market risk, I think, for energy products, because energy naturally is volatile. And so you might as well sell volatility to somebody else.
And I think too, there's a big group of investors out there that sort of, it's almost like there's never a guarantee return in investing, but you're certainly, I think you have kind of more confidence in, something like maybe a 9 to 11% yield versus with the S&P 500 over a 5-year rolling period, you might have an average return of 10%, but given the starting point, that can be 0, or it can be annualized 18%, depending on when you get into the S&P, if you get in on a bear market low, or if you're investing when it's really expensive. So I think that there's a lot of investors out there that like a more consistent, higher yielding strategy would be really appealing. So
yeah, that's what we're trying to deliver. And here, I think part of it too is that the negatives on our space historically have been volatility is too high, and oil is just naturally a volatile. All commodities are volatile. It's just the nature of the commodity business. Well, so the way you fix that, or turn it on its head, is you sell that high vol to somebody else who wants to speculate on the upside. Okay, God bless them. We'll sell you the upside. Every month you can have the portfolio return above 5%. Okay. Well, we know from options is most of them expire worthless. So we're kind of selling that upside to somebody else. We're taking the more secure bet, which is the house side. We're betting on most of those calls expiring worthless. And if it goes up, so be it. We made money. If we get called away, it's because the stock went up a lot. We made money. So we're not going to cry if we don't make every dollar. If we only make 85% of an up 20 year, you know what? We're happy. That's good. We're not going to go broke making 85% of the upside. That's the trade-off. Now, there's no downside protection. We don't own puts. So we think the way we get comfortable there is the space itself is relatively low valuation, 9 times EBITDA. It has a 6% dividend yield, and most of the companies are buying back shares. So we don't think there's lots of downside in the space because it's so healthy. So we think the downside is, let's say, 10 to 20% type of downside. Well, we're getting paid 6 in dividend yield and 5 or 6 on covered call, so we can stomach a down 10 market and still be flat. That's fine. That's good. So that we kind of think the range of returns is probably down 10 to up 20. This strategy is designed to outperform in that period, which is most of the, that's probably 85% of the return range is down 10 to up 20. So if the strategy wins in that environment, it loses up 20 and above, we don't make all the upside, and down 10 and worse, we capture some of the downside, but we don't lose as much. That's good. Most investors want to lose less in down markets and make most of the upside. This is designed to basically win on both sides of the equation. That's not perfect. It's an energy infrastructure, so you kind of size it appropriately. You put 2 or 3 or 4% of your portfolio in it as an income solution. It's not going to ever be all your portfolio. It's a piece of an income solution is how we think about it.
This has been really great, Greg. I've learned a lot. I know our audience is going to learn a lot from this and be very interested in what you've had to say. We do like to end with a standard closing question, and you can go anywhere you want with this. But based on your experience in the market, if you could teach one lesson to your average investor, what would that be?
It's a Warren Buffett principle. Basically, buy what other people don't want to own. And in my case, it's going to be energy. If most people don't want to buy energy, which is the case today, it means those stocks are going to be cheap. They're not popular. And so buy high quality energy infrastructure companies that are not popular, but are basically cash flow generators, and then hold them forever. Because buying cash flow cheap is a winning strategy. It's as simple as that. And they're not popular for cocktail parties, and some people are going to get pissed if you own fossil fuel companies. But at the end of the day, just tuck them away and hold them for 20 or 30 years because cash flow makes you a lot of money over the long run.
Good stuff. Thank you very much, Greg. We appreciate it.
All right. Thanks a lot, guys. Appreciate it.
Thank you.
All right.
This is Justin again. Thanks so much for tuning into this episode of Excess Returns. You can follow Jack on Twitter at @PracticalQuant and follow me on Twitter at JJCarbonell. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. We appreciate it.
Justin Carbonell and Jack Forehand are principals at Validia Capital Management. The opinions expressed in this podcast do not necessarily reflect the opinions of Validia Capital. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validia Capital.